Good afternoon. Thank you for logging into today's webinar about 5 portfolio changes to make now. Here's an understatement. 2020 has been a wild year, and that extends to the markets and the economy. We saw the longest bull market ever end, the quickest 34% decline between the market peak on February 19th and its trough 34 days later on March 23rd, then had the quickest recovery ever at less than 5 months to reach new highs, a medically induced global recession to deal with COVID-19, and I won't even mention the election that may or may not be over at this point. As a result, the investment landscape has changed, and it makes sense to reposition your portfolio accordingly, which is the focus of today's webinar. For those of you who don't know me, my name is Sammy Azzouz. I'm the president of Heritage Financial Services based in the Boston area, and I've been a financial advisor for over 20 years. I'm also the author of a personal finance book, Beyond the Basics, Maximizing, Allocating, and Protecting Your Capital, and the Boston Advisor blog. Heritage Financial is a 35-person wealth management firm that helps people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning. We are currently celebrating our 25th anniversary, manage over $1.5 billion for high net worth clients, and have been fortunate enough to receive some great recognition as one of the top independent advisory firms in the country from the likes of Barron's, Forbes, and Financial Times. Today's webinar will first cover what's changed in 2020 that's driving these portfolio observations before reviewing the 5 changes that I think you need to make now. We'll then wrap up with questions that you can submit to me privately or publicly through the group function chat and get you all off Zoom within the 25 minutes we've allotted. So without further ado, let's dive right in. I want to focus on 4 things that have changed in 2020. The first is the Fed's lower for longer policy. Because of the recession that we faced this year and ongoing struggles to reflate the economy because of COVID-19, the Fed announced that they would like to keep the Fed funds rate near zero until inflation rises above 2% for some time. Given that inflation has run below 2% for a while, it's reasonable to assume that rates will be very low for years to come and that the Fed will not be worried about inflation creeping over 2%. Prior to 2020, the Fed had hoped to get interest rates to more normal levels and was hyper-vigilant about making sure inflation did not stray above its target. These are meaningful differences. The second thing to focus on this year is a weakening dollar. This chart shows the dollar strength since 2013, and it has tapered off recently, and it's reasonable to assume that a potential implication of the Fed's policy of lower rates for longer is that this weakness could continue. US interest rates and exchange rates tend to rise and fall in tandem. All else being equal, which is not always the case, with low US interest rates, investors sell dollar-denominated assets and buy foreign assets, which tends to hurt the dollar's exchange rate. The third development to focus on this year is that while the bull market that began in 2009 ended earlier this year, killed by the COVID-19 bear and the second quarter's sharp economic contraction, we are in a new bull market, as you can see here by looking at the MSCI ACWI, which is an index that tracks the global stock market. Start of the year, the bear, the recovery, and hitting new all-time highs. That may seem crazy for us all to consider given the lockdowns that are still in place, the massive health concerns, and the uncertainty we're facing over the next 6 to 12 months. However, the quote here by Sir John Templeton always helps to remind us that the stock market turns upwards before it makes sense to everyone that it should, since investors are forward-looking and bull markets typically start when things seem very bleak and grow quite nicely on investor skepticism. The fourth and final change in 2020 to focus on before getting into specifics on what to adjust in your portfolio is the strength of the so-called Fang M Stocks this year and the shift to the reopening trade. These stay-at-home large growth stocks have seen an investor love affair in 2020. You all watched the Tiger King, have used Zoom extensively, ramped up your Amazon purchases, used your electronics and social media a lot this year, and those stocks as a result have returned 45% through the end of September, Jan 1, 2020, 9/3, 2020, up 45%, while the S&P was up 5% during that time. They are now nearly a quarter of the S&P 500, concentrating that index too much in a handful of expensive names that are correlated to each other. And that level of outperformance cannot continue at this pace. And indeed, we have seen signs that market participation is ready to broaden since the market bottomed in March and we entered a new bull, and particularly recently with positive vaccine news from Pfizer and Moderna, and today Oxford AstraZeneca, that has investors rethinking their allocations and willing to move money from expensive growth stocks to more cyclical areas that have not performed as well recently, but should benefit when the economy reopens. Talking about small cap stocks, value stocks, international, specifically emerging markets within international, all outperforming growth stocks pretty sharply over the last few weeks. So with those changes in mind, what should you do about it? First, I think it's time to think about adjusting your stock exposure. Because of low rates and the fact that we are in a new bull market and those have historically lasted a while, this chart shows bull markets in green and bears in red, and is a very powerful but simple way of realizing that you can become way too fixated on the risks of those red hiccups and miss the massive stretches of green along the way. If you have been underweight stocks in your portfolio, it's time to get back to the right level of stock market exposure for your plan, situation, and risk tolerance. Waiting for another strong pullback to get back in could have you waiting for a long time. And if history is wrong, if Templeton's wrong, if I'm wrong, and the market is about to fall off another cliff, the risk is small to you if you're only investing long-term money that you don't need for a while in stocks and you can ride out any market declines. Second thing to consider is adding international stocks. A falling dollar, which we talked about earlier, helps international stocks, just as the strong dollar since 2013 was an international stock headwind. This is one reason why investors should adjust their US international stock mix and bring it more in line with the global stock market index weights, which right now is about 58% US, 42% international. International stocks are also cheaper than they have been compared to US stocks. The MSCI EAFE over here is an index of developed international stocks. Its relative valuation is lower than it has been a while compared to the US. That's the chart on the left. The chart on the right shows the same thing for the emerging markets as represented by the MSCI EM. International stocks are cheaper, and a falling dollar or a weaker dollar typically helps them. Third change to make is it's time to get in on the so-called reopening trade and lighten up on that stay-at-home tech trade. Put another way, lighten up on growth and add value. There are two charts here. There's a lot going on in this slide. The one on the right shows how expensive certain segments of US stocks are compared to their 20-year average based on price to earnings ratios. Growth is on the right, values on the left, large, mid, small across these lines. Growth is quite expensive, 152% for large cap growth compared to its 20-year average, 229% for small cap growth. Value is much closer to its 20-year valuation average, and small value is the cheapest. Then the chart on the left shows you why valuations matter and investors like to focus on them when making investment decisions. Price matters, and the more expensive your starting point, the lower your median 10-year future returns will be. When starting valuations are above 30, which is right here, the next 10-year returns are 1.41% compared to 16% when valuations are below 15. Positioning a portfolio today based on price is always more prudent than based on chasing the performance of recent winners. The fourth change relates to your bonds. We talked about lower for longer and low interest rates. The Fed's various moves have flattened the yield curve, which is shown here on this slide. Along the bottom, you have bond maturity, and the y-axis is yield. As you can see now on the September 2020 yield curve, you are not being paid much to own long-term bonds. Going out from 10 to 30 years, you're picking up less than 1% in yield, 1.46 for the 30-year bond, 0.56 for the 10-year bond. And it's a far cry even from where long-term yields were in 2013 at 3.96 versus 1.46. So since long-term bonds don't pay you much more than short-term ones, and when rates rise, bond prices typically fall, and longer-term bonds fall more than short-term ones, they are more sensitive to interest rate hikes. You should reposition your bond portfolio in short-term bonds that provide almost as much return, stronger protection from rising rates, and the ability to more easily reposition your portfolio into long bonds when the yield curve steepens. The fifth change to consider now deals with your risk tolerance and how you responded to the March 2020 decline. It was definitely a scary environment. And like I said, in 34 days or 33 days, the market was down 34%. We've never seen the likes of it. A stock market decline, though, of 20% or more is a great buying opportunity. Did you take advantage of it by buying stocks? Did you hold on to your portfolio, or did you end up selling? Our team did the first and purchased stocks twice for clients during March and entered the recovery with a higher allocation to stocks in our portfolios than we had during the decline, which you can see in the top half of this slide. It's a plan we've had in place and used before, as you can see from the bottom half of this chart, looking at global stock market declines in 2016. If you sold and locked in losses, it's time to make a plan to get back into the market now, so you're not waiting years for another attractive entry point, and work with your advisor to reassess your risk tolerance so that you can ride out the next decline, or better yet, buy stocks. So to recap, the Fed's low rate policy, a weaker dollar, start of a new bull market, and markets rotating out of large growth stay-at-home stocks give you good reason to make a few portfolio adjustments. Get your stock market exposure back to the levels it should be based on your plan and situation. Incorporate international stocks in your portfolio at close to the global stock market average of 42%. Diversify your portfolio by adding cheaper stocks, smaller stocks, and reduce your concentration in large growth US. Reposition your bond portfolio to own short-term bonds that should do better in a rising rate environment. And if you sold stocks in March, get back in and reassess your risk tolerance so that you don't get out of the market again at the wrong time. And with that, I will pause and see if there are any questions in the chat feature. And as I mentioned at the beginning, if I don't, or I didn't mention at the beginning, sorry, if I don't get a chance to answer all of these questions, or if anybody wants to follow up with me directly, I will share my contact information on the last slide. You can, for next steps, you can reach out to me with any questions. Here's my email address or my phone number. I'd be happy to send you a copy of my book if you do not already have one. You can follow along the blog, thebostonadvisor.com, where I share a lot of these thoughts. And I'd be happy to answer any questions about your portfolio and how it's positioned in the current environment. So pause here to see if there are any questions in the chat. So the first question is always one that advisors love. What are your thoughts on gold? Gold, for an investor who focuses on price and the idea that price matters, is a bit of a challenging investment in terms of figuring out where it belongs in a portfolio. It's definitely historically been driven by the idea that people like to buy gold when they're nervous about the market, they're nervous about inflation, they're nervous about other things. And so the investment thesis is not valuation driven as much as investor reaction driven. And for value investors, or for investors who make asset allocation decisions based on price mattering, it is challenging to commit to an allocation to gold. It definitely has its proponents. It definitely has its advocates. I would say if you're going to own gold, you need to understand that it is very volatile. It does experience periods of volatility that are comparable to stocks. It doesn't always have a clear path to return, and I wouldn't want to trade it. If you're committed to the idea that gold or an alternative form of currency belongs in your portfolio, you should put a small position in there and just leave it till the end of time, because I'm not sure how to trade something like that. Great question. Thank you. Any other questions before we wrap up? And as I mentioned, please feel free to reach out to me directly if you have particular questions, you want some follow-up information or a copy of the book. But thanks again for joining. I hope you found the webinar helpful. We will send out a short evaluation form because it's the first one we've done. And I'd really appreciate any thoughts on the content and how we could do it better next time. Oh, one last question snuck in before the deadline. Real estate. I love real estate. What are your thoughts on real estate? Real estate, like any other investment that you can get into at the right price, is definitely attractive. There's a chapter in it on real estate in the book. I will say that real estate is a form of a business. You can make money in it, and the returns are very attractive. They typically come with leverage, you shouldn't be afraid of debt if you're going to utilize real estate in your portfolio. It is more work typically than a hassle-free investment portfolio. And at some point, you are going to have to transition the real estate funds or positions that you own, the investments that you own, to the next gen, like you would with any other business. So we do work with a lot of real estate investors who, as they enter retirement, need to figure out what to do with their holdings, just like a lot of business owners do. So I'm a fan of real estate, but you're going to need to be comfortable with leverage, with being more hands-on, and eventually you're going to need a succession plan for the real estate that you accumulate. Another question related to that is REITs. REITs that are, what do you think about investing in REITs that are beaten down and have high yield, which connects to a third question on alternative investments. There's definitely an opportunity, given where yields are, to look, and them being so low, to look for yield in other places. With the 10-year, yielding below 1%, people have been tempted to search for yield in either dividend-paying stocks, real estate, real assets, REITs, things of that nature. Definitely think that REITs belong in a portfolio. They are attractive. Publicly traded REITs do have a lot more volatility than your typical real estate investment, like private real estate, I guess I should say. So you have to understand that the risk return profile of publicly traded REITs is a little bit closer to where stocks are. I think you have to get under the hood on the yield and how safe it is. But I definitely think that they belong in portfolios. And it depends on the path you're trying to choose for your portfolio. Are you trying to generate income, which is harder to do in a low rate environment? Or are you trying to generate total return by which you can withdraw a safe amount from every year? And if you're focused on income, REITs may be appropriate with the yields that we have now compared to the alternatives. And they may deserve a bigger place in your portfolio. If you're focused on total return, which is typically our approach, I think they belong in the portfolio, but maybe at a smaller allocation. And that goes the same for that other question that I mentioned. Alternative investments that are not directly linked to the stock and the bond markets in terms of correlation, that provide a yield, provide an alternative path to return, belong in portfolios, particularly as you are living off your portfolio, and smoothing out returns is important, as is income generation. But like gold, like real estate, like REITs, like a lot of things that aren't stocks and bonds, they do require an extensive amount of due diligence to understand what's driving the return, the quality of the managers, and the things that could go wrong. Next question is very similar. Thoughts on preferred stocks. Preferred stocks, higher yield, but higher risk. And so I think it does depend on what your strategy is with them. If you are looking for purely income generation, they may belong in your portfolio, but I would expect that other people in the market are thinking along the same lines that you are. And you just want to make sure that you're not adding yield with a disproportionate amount of risk to get that yield. Preferred stocks are not risk-free, even though they do behave a little bit differently than regular publicly traded stocks. They do typically get concentrated in a few sectors. So if you are going to incorporate them in your portfolio, I would do them in a much smaller allocation than some of the other major categories of investments that typically people focus on. Great. These are awesome questions. Thank you so much, everyone, for participating and asking. And got a couple minutes left, so I would just echo what I shared earlier. If there are any questions or anybody wants to shoot me an email with more specifics, either about their portfolio or getting a copy of the book or information on the blog, please do so. I'd love to continue the conversation. And thank you again for joining us. And thank you in advance for sharing any feedback that you have about the session. Have a great day and a great Thanksgiving, everybody. Bye-bye.